Well, greetings and salutations, Series 65 test takers. This is Dean Tenney, aka the Series 7 Guru, joined by Brian Lee, aka the Test Geek, managing member, Test Geek Exam Prep LLC. We're working our way through on our podcast series, the Series 65 exam, and this is episode 4. And what we're going to be talking about in today's episode of the podcast is investment vehicles. Brian and I have discussed in previous podcast episodes that we think people underestimate the investment challenge on the 65. Depending on your background, this can be one of the more challenging parts of the exam. Brian, your thoughts on episode 4 before we get underway?
Absolutely. That was the first thing I was going to mention. When I see or talk to folks who unfortunately don't pass the first time, I always ask them, look at your score sheet. This is where the first place you want to start. They go, where do I go now? Right? I just got a 68 or 69. Where do I go now? I say, the first thing you do is look at the score sheet. And I'll bet you that's going to tell us where the weak area is. And Dean, probably 7 out of 10 times, the lowest area is investment vehicles. Everybody would probably guess it was the laws and regs, right? Because of the challenges of all of that stuff. But man, I'm telling you, investment vehicles. So I figure, why is that? What is the reasoning behind it? One, as you just mentioned, maybe not as much investment background. Perhaps their primary source of business is insurance products. So that might be one reason. And the other reason is because of some of the more esoteric investment and investment analysis concepts that they're not used to, right? The derivatives, the investment analysis, those sorts of things. So it's a very important area. I always tell people I can't get on the highest mountaintop enough to tell folks, don't forget your investment vehicles.
Yeah, I think, Brian, it's funny too. I just had this the other day. Most of the time when people fail, a lot of times what they have in common is they almost passed every category. They didn't have a category that took them over the top. But I had a young lady the other day who scored, still failed, which is surprising. Got over 80 on the regulatory part of the exam and bombed the investments so badly that it drug her back into the not
Like
passed category,
53%.
which was unique. And I told her, well, good news, I guess, that we know where you need to spend your time in remediation. So we're going to be talking in today's episode about bonds and bond yields. We're going to be talking about investment companies. We're going to be talking about derivatives. And we're going to be talking about discounted cash flow in terms of analysis. So that's kind of our agenda for today. And we're going to get started with bonds and bond yields. I think people underestimate how much of the test is about bonds as compared to stocks. Very rarely do I have, Brian, somebody say, oh, I missed the mark because of common stock or preferred stock. It usually has something to do with the bonds. And the two bond risks that you are going to be asked about are credit risk and interest rate risk. And I think more candidates are challenged by the interest rate risk questions than they are the actual credit risk questions. We'll talk about both here in just a moment. Brian, do you have thoughts on bond and bond yields as it relates to passing the 65?
It's amazing. I think you were the one who said this, and I think you said it in relation to Series 7, where they used to call it the stockbrokers exam, when it should be called the bond traders exam. I don't know why the regulators do this, but they do seem to like to concentrate on debt securities, right? And 9 times out of 10, the folks that we are talking to here aren't going to be trading stocks, let alone bonds, that much. But it's always a big portion of the test,
Yeah.
right?
Yeah.
So, it's an area that we must score fairly well with. Absolutely.
Yeah, and you're going to get, you don't have a lot of target-rich environments. So when you do, whether it's bonds, something like that, you do have to be able to perform. Now, on your 65, there are 3 issuers of debt-denominated securities, bonds, that you're held accountable for: corporate issuers of bonds, municipal issuers of bonds, and the U.S. Treasury. Now, in terms of the credit risk, the U.S. Treasury can confiscate money from others. It has taxing power. And the U.S. Treasury can print little green pieces of paper that people will accept. And so there is no better credit quality than that of the United States Treasury. So, whether we're talking about T bonds or T notes or T bills, we don't have credit risk. Now, we're certainly still going to have interest rate risk in Treasury notes and Treasury bonds that we'll be discussing. Municipalities are considered the second safest form of credit because, again, they have that on the GO side, the ability to confiscate money. I'm joking. Taxing authorities, what I mean by that. 50,000 municipal issuers of securities with about $4 trillion in debt outstanding. And you're certainly going to get a suitability question about munis. You're going to get questions like your customers in an uncomfortably high tax bracket. And, you got to recognize that we should probably recommend a muni. I'd even be prepared for questions where you have to do practical application, which for suitability questions are good that you have to do practical application because it's less judgment whether they should buy a corporate or muni depending on their tax bracket. And then corporate issuers of securities. And on the corporate side, we have secured bonds and unsecured bonds in terms of the various types. In our podcast, we're not going to get too much in the weeds about types of corporate bonds or GOs versus revenues and that kind of stuff. We're trying to fly high and give you an overview of what you could expect. And one thing they really do kind of torment you on is the difference between or the relationship of yields and prices. The bond price is either going to be less than par being 1,000, par. Now, we would make the assumption that when the bond was issued, it was issued at par. And then it's going to be trading in the secondary market, either a discount or premium. And we have to know how that relates to interest rate movement since the bond was issued. I'll talk briefly about that in just a moment. I would want to see Brian's thoughts on this, Brian. I find more often than not, they're testing you on recognizing the bond at a premium. A little more straightforward that interest rates go up and the bond is trading a discount, that inverse relationship, and you might lose principal value if you don't hold the maturity. But I think you do have to be able to interpolate a bond's yield based on the yield to maturity that they give you, stuff like that. Your thoughts on the testable part of yields and prices?
Oh, I've got lots of thoughts. Actually, the way I typically describe it for my students is I first start with the static part, the basic characteristics of a bond, the coupon rate, also known as the nominal rate, the par value, which all those two things do is to determine our annual income. And most folks are fairly well versed on the static part, but then the dynamic part, right? When the bond is trading in the secondary market, its price fluctuates due to changes in interest rates. So then things start to change. So for me, I like to take a look at it from two different aspects, the static part and the dynamic part, right? As interest rates change, the market price changes. As the market price change, which will affect our return on investment based on if the price of the bond drops below par at a discount or above par at a premium, and how that relates to our return on investment. Now, one thing again, here we go with the textbooks. I'm sorry, I'm going to rail on those puppies again. But again, they start getting into a lot of the math on the yield calculations. But as Dean said, that relationship between prices and yields is the important part. It's the relative differences. It's not really the mathematical difference.
Yeah, I get bond geeks, Brian, who sometimes, we all, I don't know if you use, I'm pretty sure you do. A lot of us use what's called the teeter-totter or seesaw to illustrate this relationship, the inverse relationship of interest rates and bond prices. And as you know, Brian, one of my favorite things I tell people is if somebody asks you about economics, finance, or investments, you want to sound smart, you should say it has a lot to do with interest rates. They say, what about them? They fluctuate. Now, I do get bond geeks every once in a while, Brian, who say they don't like the teeter-totter, and they don't like it because that relationship is not linear. And the teeter-totter makes it look like it's linear.
That's right.
And what they take exception to, and it's I get it because it is a testable thing to understand, is the sensitivity to interest rates is based on the maturity and that coupon. So, we're going to ask you on the test to recognize volatility. I usually tell my test takers, Brian, to just shop the answer set when being asked about volatility or sensitivity of a bond's price to interest rates to go through the answer set. Look for the longest maturity. And if there's a tie, then the lowest coupon. And the way I say it is long and low, long and low. And that would be the one with the highest sensitivity, the highest volatility. Your thoughts, Brian, on that kind of a question?
Absolutely. And again, it's part of, I guess, the analysis of the more dynamic parts of the bond is the effect of interest rates on prices and yields and how sensitive they are. How many times, and I bet you this is across all the exams, where they give you a scenario where an investor is a fixed income investor, right? And he's concerned with rising interest rates or falling interest rates. And the question, which of the following would be least appropriate or most appropriate? When they're asking about which one is least interest rate or most interest rate sensitive, absolutely. And first thing you look at, longest maturity. After that, it's the coupon rate, the lowest coupon. So you're absolutely right, long and low.
Long and low. And, we have current, we're coming to you in 2023, mid-April. And you can see this in the real world right now with Silicon Valley Bank, right? They thought they had a relatively risk-free portfolio of government securities, but they had a portfolio of long-term bonds, and they weren't able to hold those to maturity. You'd be immune from this sensitivity if we just held the bonds to maturity in your portfolio. When I was a practitioner, I'd say, listen, we're not participating in the secondary market. We're just going to buy the bonds, hold them to maturity. So even though you're getting a statement every quarter, don't worry about it. But if you're forced to sell your bonds early, and since you bought them, interest rates have gone up, it's going to be a loss. Now, the fancy word, Brian, as you know, on 65, the fancy word, I always tell my test takers, every time you see this fancy word, just change it to volatility, and I think you'll be fine. And this nonlinear relationship that my test geek, not test geek, bond geek guys take exception with is called duration. Right. And you would expect to see a question about duration. It's just the fancy word for this sensitivity. And I don't even think you need to worry about it being a nonlinear relationship, to be honest with you. Brian, your thoughts on duration as tested?
Absolutely. But I believe it's very basic. And I think you're absolutely right. The simple solution for the test question, duration equals volatility.
So higher duration, higher volatility.
And that's really all as far as that duration is concerned. Again, the textbooks will probably get deeper into that. Sorry.
Yes.
But really, it is a fairly basic definitional question. Which of the following best describes duration, right? It's a measure of volatility in bonds. That's really all it is. It's not that much. It's for those, when they give you the 4 bond choices, which is least or most effective.
Yeah, just make sure you're on the right side of the question as well. And make sure you're reading that question correctly, because every once in a while somebody will apply what we've said and then they'll send me a screenshot. You told me this. I go, whoa. Please read the question again. It didn't say most volatile. It said least volatile. That would be the opposite. So you got to make sure you're on the right side of the question.
Now I'm going to set you up, Dean. Let's see where we go with this.
Okay.
What about the math calculations for yields?
I always tell people there is no reason that you should not be prepared to do current yield. What an investment pays you divided by what it costs you. I further say, if you can't decide what to do, you should do division. That I'd be doing you a favor to cover every key on the calculator except the divide key. The relationship is what you're tested on beyond current yield. So it's not, can you tell me the yield to maturity? Fancy word for that is basis. Not, can you tell me the yield to call? But where would that be in relationship to the nominal yield? And that's why I think it's so important. You got to believe on the test and what I call human depravity and original sin, that, if we didn't have kind of a ethical foundation, we might take advantage of people not understanding this relationship. For example, I call you, Brian, and say, hey, Brian, brand new bonds only pay 6. Mine pays 9. Now, if Brian is on to this, what we're talking about, I say, well, Dean, don't I have to pay a premium for that bond? I said, well, Brian, you're no fun. I said, Dean, if I hold it to maturity, isn't there going to be a loss by holding it to maturity? I go, okay, Brian, you got me. The yield of maturity is, and we go, Dean, isn't going to get called. So the other thing you just need to know is that when we buy a bond at a premium, that yield to call is the one we want to focus on in terms of making that decision. And when we buy a bond at a discount or par, it's going to be yield to maturity. And the reason is most people don't buy bonds for current yield, and most people don't day trade bonds. They buy them where they're at financially already, Brian, and they're just marking time, so to speak, investment wise.
So you passed.
Okay.
I was going to throw you in the trap and see where you went with this, and it's exactly right. I try to tell people this so often, but again, the textbooks are pounding them with all this mathematics, and it's what's most important about the bond yields is not the math, it's the relationship.
That's
if it's
right.
a discount, you got to know the yield to maturity, yield to call is greater than, right? If it's a premium, it's less than. It's their relative values, right? It's not the mathematics so much. Again, you're absolutely right. The most common math yield question is the basic current yield, annual income divided by market price. And I'll bet you dollars to a bag of donuts, Dean, that if you looked at the answer choices and knew the relationship, it's bought at a discount. So
I was just going to say,
current yield is going to be greater than coupon.
you know it, Brian.
Probably don't even need to do the
That's
math.
exactly it, right? And sometimes, Brian, people think they're being asked to crunch yield to maturity when they're not. They go, "Oh, you told me I wouldn't have to do this." And here's the question. I go, no. If you look at the question, I call it, a hack before you do the math. Just look at the question and say, do I really have to do this math? Are they trying to send me down some road? Or can I just look at that relationship? And I'm with you, Brian. I have never had to stand corrected that you actually have to crunch yield to maturity, because if you understand the relationship, the number becomes transparent. So
exactly, that's exactly right. It's about the concept. That's what they're testing you on, is the concepts of bond prices and bond yields, not the mathematics. This is not a math test, right?
But bonds, bonds. I like today's episode because one of the challenges on this 65 is there's not a lot of target rich environments. It's a lot of onesie twosie. Bonds is target rich. And our next discussion is target rich. The next thing we're going to be talking about are investment companies, open versus closed. And again, I think this is another area like bonds will people underestimate the content. Some of them come to this with a little bit of hubris, perhaps, Brian. I think I get some like Series 6s who go, "Oh, well, can they ask me about a mutual fund? I don't know." Bad attitude. So lots of questions here. We're going to be talking about one of the major test items, which is contrasting an open-end fund with a closed-end fund. Before we do that, Brian, your thoughts on this category on investment vehicles as it relates
to target rich, no doubt about it. And I like to list them in order of based on similar characteristics. So open end is actually on one side, closed ends on the other side. And you're right, they come in with a little hubris, not a whole lot. Well, I got my Series 6 18 years ago. I go, yeah, well, good luck with that. Tell me, can you name a closed end fund? No, I can't. What is a closed end fund? They might have some knowledge of an ETF, not a lot, but you've got to know, and you got to contrast those characteristics between those different types of investment companies.
And I usually say, Brian, what they have in common is in a open and closed, what you're availing yourself of is professional management, diversification, and ease of ownership in both formats, right? For most retail investors, the easiest way to access professional management is through a mutual fund. And it's the easiest way for most investors to avoid selection or non-systematic risk. That being said, open-end funds are continually offering new shares to the public. And that means not only they're going to comply with the Investment Company Act of 1940, they're also going to comply with 33. And that's a primary transaction. Now, I'm with Brian. I have one of my all-time favorite slides. And every time I put that slide up, I go, this is probably the most target-rich slide you're ever going to see. And it simply does what Brian is saying, contrasting an open-end fund with a closed-end fund. The biggest testable distinction, for example, I'm not, Brian, a good prospect for a domestic mutual fund. Hubris on my part. But you say, Dean, do you have the time, temperament, and expertise to be managing money? I'm going to respond by saying yes. The vast majority of people are going to say no, making them a good prospect for a mutual fund. However, there are areas where I think I should be invested where perhaps I don't have the time, temperament, expertise. One of those would be Mexico, for example. And Mexico has a closed-end fund called the Mexico Fund, MXF. And I don't want, Brian, my manager, to have to sell off securities to meet redemption requests. So in a closed end, we say to you as a shareholder, if you aren't happy, if you can't handle the volatility or heat, sell your closed end shares to someone else for more than or less than you originally paid. It's much like buying a stock. It's like a commission. It's
Exactly.
not, the max load of 8.5. Now we could do that slide, but this is a podcast. And so we're just trying to, point out what you're going to be tested on, and we'll leave it to you to do more in depth. But that being said, Brian, was there something else you would like to add to this? How important this is to their success?
Exactly. And those differences between the open and closed end, right? And the primary versus secondary transaction. Now, again, that's a little kind of 30,000-foot level.
Yeah.
You want to get down a little grittier into that.
One class of equity.
Exactly. And you're buying only once a day for an open end at the NAV.
Forward pricing, very testable.
The closed end trades throughout the day at a constantly fluctuating price, right? That can be above or below NAV. So yeah, you got to get pretty nasty, down and dirty. With
break points, letter of intents. I mean, so lots of stuff there.
As a matter of fact, speaking of calculations, NAV is often a calculation. How is an NAV calculated in an investment company, which is actually fairly easy. Just take all the assets, less the expenses that the fund incurs, and you have the net asset value divided by the number of outstanding shares. That's that easy. Yep.
Please note, ladies and gentlemen, Brian, I don't know if you encounter test takers get confused about what makes the NAV go up or down. The biggest thing to remind yourself of, it's a portfolio of securities, and what makes NAV go up or down is the securities in the portfolio going up and down. Don't fall for the trap of additional people buying more shares of the fund, or people redeeming, causing a chain the NAV. It does not. And that's one of those things that you can get asked about in terms of what causes NAV to go up or down in relationship to this.
That's right. Okay. One last thing, I think, and I guess it is kind of a suitability issue, and that's the different share classes.
Absolutely.
And they're always tested. I don't know anybody who doesn't get at least one question on share class. And it can be, Dean, sometimes, just the basic definitions or suitability. What type of investor would buy Class A's versus Class B's versus Class C's? Long-term, large amount, long-term, small amount, large amount, that kind of thing. So you got to be careful of those different share classes.
Yeah, and also the 12B1 fees. Make sure you understand the 12B1 fee is a promotional expense. It's not part of managing the money. And, the expense is paid, by the fund for promotional expenses. But I would know that 1/4, 1%, we can still refer to the fund as no load over the life, no more than 3/4%. And the test does assume that a lot of you are going to be agents of the broker dealer as well as 65s, and need to, know about break points. Don't make break points are good. Break point sales are bad. That kind of thing as well. So yeah, absolutely. I find more often than not, the C share is never the right suitability question for somebody.
Not
A or B usually,
historically, but I've been hearing C's.
Okay. I would think it would be inappropriate. Well, the thing I would be expecting is that the C share would be inappropriate for a long-term investor, right? So if you're long-term, it would be A or B depending on the amount you're investing.
And also it's an asset-based fee. As opposed to the other ones. Again, it's probably just definitional.
Well, and remember the asset-based fee. I like that, right? And the asset-based fee, remember, doesn't go away. So, at some point you might be better to just pay the load once and be done with it than pay that continuing on and on. Are we ready to move on to derivatives?
Absolutely. Let's talk some derivatives.
So Brian and I were just talking the other day about what to do with the 65 is just such a platypus, it's neither fish nor fowl. And one of the things that is challenging is how much are you going to invest in certain areas of this exam? Because remember, all you're really after is making the mark. And, do you need to turn yourself into an options or future expert? I would say no. And Brian, we were talking about, we joke about the draw. It's completely random, but I joke about getting a dream draw. Everything you studied shows up, but you got to be prepared for the face of death draw where, you're, oh my God. And what I think we were talking about, where you're going to get one or you're going to get six. And it seems like test takers either get not enough that they should have spent as much time on it, or so many that they should have spent some more time on it. So, um, I don't know we're going to be able to do this justice. As I say, Brian, I have hours of options videos in my playlist, and I put a couple in the 65, but oh my God, there's like 90 videos in there. So
I
in that
like doing my
playlist,
little options dance.
there you the matrix. I use the matrix. What do you call that? Home base
Options
or
aerobics diagram.
options aerobics? Call
It
up,
goes
put
with that
down.
little dance. Yeah.
So let's start there. Let's start with derivatives. So derivatives derive their performance from the underlying asset. Brian, I think my friends are kind of fun because they really do think they own a football team or a basketball team. They engage in fantasy football. And sometimes I can't understand why they're so excited about something. And oh, that's my player. Their performance derives it from the real football games. The real football players and games are what's driving the performance. So in the derivatives you're held accountable for on the test, they're going to be deriving their performance from the underlying interest, for the most part, either a stock or an index. And I think where a lot of people struggle is they think there's a lot of things going on. There is not. There are only two types of contracts, and those are calls and puts. Now, you can either buy them or sell them. Hence, we have four basic positions. And I always say, Brian, the most important thing I would want a test taker to be aware of is an answer set that says A, long call, B, short call, C, long put, D, short put, and then know what those contract
What's
specifications.
long and short mean?
Well, we can use a lot of words for that. I told you, Brian, I'm demented. I like to use it outside of our securities industry. I like to go into Starbucks and say, hey, I like to go long a vente. That just means I want to buy it. So, right, there's a lot of words: long, buyer, owner, holder, that mean all the same things: short, seller, writer. It is a challenge. It's kind of like learning a foreign language. The 65 in and of itself, right? When you dream the language, that's when you know it. So I guess when you have your first 65 dream, that's when you're on that. Now, I would be prepared as a 65 test taker to know that some people, the two people coming to the options market and the futures market as well, are either speculating or hedging. They're either coming to the marketplace and saying, I would like to buy a call, be able to call the stock away because I think the stock is going up, or I want to buy a put because I think the stock is going down. And again, it's again, the gambling, right? I got a horse right here. His name is Paul Revere. Not a song about a guy who owns a horse. It's a song about a guy betting on the horse. So some people are just betting on the underlying. And the other set of players are hedgers. These are people that actually have a long or short stock position. My experience has been, Brian, that the option questions that people encounter are usually more on the hedging front, meaning how do I protect my stock? How do I buy insurance to protect my stock portfolio, systematic risk, or a particular stock, unsystematic risk or selection risk? And that would be buying a put. We're not going to go into on the podcast an options lecture at this point, but that would be it. And then understanding too how you would hedge a short stock position, knowing that if it moves against you, it's going to go up. And so what you want to have is a choice to buy back the borrowed stock. So I think I would be more focused on the hedging types of option strategies than speculation. Brian, your thoughts on that?
Absolutely. When it comes to the Series 65, again, right, you're either going to get one or you're going to get five. So let's plan for the worst, right, and hope for the best, kind of thing. I think those questions essentially come down to several things. Who's bullish or bearish? In other words, who thinks the underlying security is going to be going up, bullish, or who thinks it's going to go down, bearish, right? That's probably one of the basic option questions you'll see. Number two, these contracts theoretically give investors the right to buy or sell the underlying security at a specified price. And the question might simply say, which of the following investors have the rights to sell the stock away at a specific price. And guess what the answer choices are?
Long put.
Long put, short call, right? That's it. So who's bullish, who's bearish? Who has the rights to buy? Who has the rights to sell? So there's two questions there.
Mhm.
Maybe a question on the expense of buying or selling options. We call that the premium. That's the market price of the option. That might be a question. And then again, the other one that Dean was just saying, almost always there's going to be a hedge question where you're combining an option with a stock position. Now, the one thing you have to look for in those questions, are they looking to protect against loss, or are they trying to generate income? Because that's going to help lead us to which answer it's going to be. If I may say, my dear old dad once told me when I was 16, son, always buy protection. So if the hedge question's looking for protection, you know you're going to have to buy the option. And to generate income, you know you're going to have to sell.
You can get just from again, I just want to stress exactly right, Brian. Again, it's about that answer set. You got two types of contracts, calls and puts. You go long or short, buy or sell. There's four basic positions, and that's the answer set, right? A, long call, C, long put. And if it's protection, it's one of those two. That's a 50-50 right there.
That's right.
If they say bullish, you're not going to be you're going to either go long the call or short the put, but mainly it's going to be just one of them. It'll be transparent. If it's bearish, no, don't be a dumb bear. A short call is just not very smart in terms of you don't have the stock. So yeah, it's mainly, can you move around that answer set in terms of contract specifications? Brian said bullish or bearish. Excellent, Brian. Anything else before we talk about futures?
Yeah, again, one other thing about that, I think the textbooks will go into, how options are exercised, and that's where you start with the option and you end up with the stock and at what price, and that's where it gets complicated over, and it's too much.
I totally agree. It's too much. And Brian, I got to say, I'm guilty too. I mean, I'm guilty. I mean, guilty as charged because I have too much too. And it's hard because we're talking about, I love what you said, prepare for the worst and hope for the best. And so part of me, I'm always tinkering with the 65 playlist saying, okay, well, if it's the worst, let's throw this video in there. Oh, but wait, if it's not, it's going to be too much. So it's really a challenge. I think it's a challenge for you as a test taker to make your editorial decisions about how much time and resources you want to put in a particular category. Brian and I are here to help in these podcasts and helping you make that decision. So if you think you're getting in the weeds, you can just comment in the podcast. We do check our comments, and we'd be more than happy to do that. Or if you even want to, tell us what question you're looking for, and we can comment and say, I think sometimes we'll say, don't worry about. Brian's more aggressive, like it ain't there and I ain't talking about it. But I might say something like it's not there as well. But I also would say something like low probability or high probability in terms of you as a test taker. Brian and I both agree. Test prep vendors are total overkill. We've talked about it before. We don't want to go on another rant, but it's called the chunk theory again. They all have one option discussion, and that option discussion, that chunk is in the SIE, even though it's not necessary. Series 7, where it is necessary, that's where that content originates. Right. And then it drifts into the 65 and, so. All right. Are we ready to talk about futures briefly?
Yeah, futures. And I got a question for you. Well, if you want to start with futures, I have a question for you specifically about forward contracts. But go ahead.
Okay. So I actually think futures, hard to believe you might think as a Series 65 test takers, but I actually think futures are easier than options. And they're easier.
Yes.
Yeah, yes. Because there isn't four things, right? This is pretty simple. You're either going to go long or short the futures. And if you're going long the futures, you think the price is going up. So if you're long soybeans or you're long lumber, the futures position, you are expecting it to go up. Now, again, same players. We got speculators and we got hedgers. And if you think the price is going to go down, then you're going to go short the futures. Now, in terms of one other question, they do ask you to contrast sometimes forwards with futures. And why is a futures contract a more attractive alternative? In a forwards contract, that could be just me as a soybean guy agreeing a soybean farmer to deliver to my local grain elevator X bushels of soybeans, and they agree to pay me. And the basic problem with that two-party contract is the counterparty risk. I don't deliver the soybeans, or if I do, what quality they are, and they have the risk that, I have the risk they can't pay me. And so the futures contracts are standardized, and you have, exchanges and clearinghouses. And so you have two major benefits that you would want to know about futures versus forwards: contract specifications and counterparty risk. Brian, you had a question for me, or you want to?
Well, yeah, if I may expand upon that just a tad. Oftentimes, and you said there's really two groups of people who are in this market, and those are consumers of these commodities. I always describe the situation with airlines buying gasoline futures because that's the biggest expense of their business, and it's one of the most volatile commodities on the planet. So if they buy a gasoline future, right, because they're concerned about the price of the gasoline going up, at least they'll have a locked-in price in which they can purchase the gasoline, so they can plan their business for the next 6 to 9 months on that specified price for the gasoline. The producers are concerned mostly about the price of their crops going down. They are the ones who sell the futures, so they can lock in a price in which to sell.
Yeah.
Now, the question I had for you, and I don't want to put you on the spot here, but again, have you ever seen or heard of any retail customer ever buying or selling a forward contract?
Well, yeah, I don't know. I'd have to think about it, but here's what I would say. There are, I do make the argument on 65 that you may be in the Midwest. And I joke, Brian, peoples in the Midwest are more obsessed with the price of beans than
absolutely
as obsessed as we are about the stock market. And so the answer is not your typical retail investor, but do I think there's, I would classify the farmer as a retail person, even though maybe not. I mean, he's got sophistications, so to speak.
Absolutely.
But the way I say exactly kind of what you say when I'm teaching series 3, which is commodities, is you do in the futures market today what you're going to do in the cash market later on, which is your point about the price for the airlines, right? I'm afraid that oil is going up. And so I go long the futures, and I hope that I make up in that futures position some of the money I'm going to lose in what's called the spot market or cash market. Your point about producers, I'm afraid the price is going to go down. And so I short it, and I hope to make that up in that futures position. I think these questions on your 65 are very basic about just going long or short. If they ask you to do any math, everything is there, how many bushels and what the premium or what the position was. So I think options are more important than futures, would you say, on 65?
Absolutely. And there's typically one other question on the test that will appear pertaining to futures, most likely. I doubt if forwards come up in this, but it's in regards to the Uniform Securities Act. It's a law and reg question that, though they are derivatives, just like options, they are not classified as securities.
Yeah, they have their own regulatory framework.
Register as an agent to sell futures. It's some other.
The way I say it is that it's just they have a different regulatory framework. It's not that they aren't a security; they are. It's just Commodity Futures Trading Commission is the regulatory authority there. The state administrators do not have authority over the commodities because it would be a mess if every state administrator was involved in what we're talking about, hedging, or futures and soybeans. So indeed, I definitely would know the futures contracts for purposes of the Uniform Securities Act are not securities. I'm totally with you on that one. All right. Now, Brian, you are, I think, somebody who can give people who have math phobia, not a cure, but some therapy. And I just love the way you lay out some of the math on the 65. And so the last thing we want to talk about in today's episode is analysis, mostly discounted cash flow, and how somebody might encounter that on their 65. Your thoughts on this one, Brian?
See, this is, again, I always had this conundrum. We all did. We studied for the Series 65, the laws and regs. They're 200 pages of the textbook. They're difficult. They have, weird legal language. So we're all, diligent in studying our laws and regs, and we end up scoring highest on that and lowest on the investment vehicle. So I'm saying why? Why is that? Right? It's stocks and bonds, for crying out loud, right? But it's the derivatives, right? These esoteric, it's the futures and forwards, and it's the investment analysis. Theoretically, that's what IAs and IARs do more than broker dealers and agents, according to this test, right? So the investment analysis is a pretty big part of it. When analyzing debt instruments, bonds, one of the big analysis tools they use is this thing called discounted cash flow. Now, on my video course for the Series 65, I tell people, I say, look, how many of you out there have a finance degree, right? Now, speaking to my class, there might be 3 out of 10. The rest of us don't have finance.
And they're very disruptive when they're in class. I wish they weren't there.
So how are we going to understand these sophisticated financial analysis tools when we don't have finance backgrounds? I go, well, you see the first word, discounted. What's that mean? How does that apply? I don't know. All I see is the last 2 numbers, cash flow. That I can get my head around. Okay, how much cash, actual cash, is this investment going to generate? For bonds, of course, that's interest, right? Oh, I know. Okay, so how much interest this bond's going to create for me, income, for the next 10 years? I can get that, right? Based on that amount of income, I can then compute, well, the finance guys can compute what would then be a fair market value to purchase this debt instrument based on that future income, future cash flow, however you want to say it. One other thing about the bonds is you may have to be, or you may be asked, what are the components that determines our cash flow for a bond? Well, we just talked about it, 20 minutes ago. The coupon rate, which is a percentage of the par value, and its maturity, right? Coupon, par, that tells us the annual income. Maturity tells us how many annual incomes we're going to get. So those are the components that tell us how much income we're going to receive in the future. From that, we can then determine a fair market price for that bond. That's discounted cash flow. That's all it is. It's determining a fair market price based on the future cash. Now, stocks, they're a little bit more difficult, except for preferred stock. Preferred stock, they have fixed income, so we could do a little calculation, and that's called the discounted dividend discount model, right? So, and that's probably all they ask on the 65. 66, they might get a little deeper with that. But for preferred stock that has a fixed income, we use what's called the dividend discount model. For common stock, where the dividend can be variable, right? It can go up over time, can go down over time. It's a more complicated, more sophisticated thing. Again, if you see it on the test, they will simply ask you, what is the name of the method? Dividend growth model.
Yeah,
That's
the
it.
other one I'd be prepared for, Brian, too, is just as a low probability, but if you assume, if Mr. Buffett, who's a big math geek himself, says, okay, I own 1 billion shares of Bank of America that pays me a quarterly dividend of 18 cents, and he's trying to decide whether he wants to buy some more, he's going to say, okay, well, do I assume the dividend, which recently was raised to 21 cents, is can continue to grow? And the takeaway is that the dividend growth model would allow for a higher valuation of what I'd be willing to pay as an investor if I assume that that stock dividend is going to grow. I just want to give you kudos, Brian. Brian is one of the best persons at explaining math concepts of anybody I know. Just awesome. He has videos that are free on YouTube. So even if you don't invest what you should in his 65 paid supplement with all of his videos, at least check out some of those videos over there with some, particularly on the math concepts.
How many questions, Dean, do you think overall? Probably only a couple.
Here we go again, right? The challenge on 65, damn it. You know, it's such a challenge because what happens, Brian, it just hurts my heart that people go down these rabbit holes on these kind of things, and they try and turn themselves into a finance major in the 4, 5, 6 weeks they have to take the 65, and don't stay on the broad avenues and highways of the 65. And I wish I had as much moral suasion as you do, because I sometimes will not tell them to get out of the rabbit hole. I'll go down there with them And I feel really bad. I say, no, don't. There's other areas of the 65 where you can make that up. And so I don't know. I don't think it's ever going to be the difference of not passing. It's not material. I'll say it that way. And it can be detrimental to certain folks who, by the way, if they're not prepared for
That
the other challenge
statement
prizes, they swear they had 130 of them, even though we know that's not true.
that statement you just made is worth the entire podcast, all 6 episodes of what you just said. Absolutely. Right?
Which was? I don't know what I thought. I'm just making it up as I go.
What did you just say?
Well, I think when I
going
said
down
it,
the rabbit holes, it's not
Yeah.
going to make you pass. It's not going to make you fail.
yeah.
It's these 1 or 2 questions, right? That you really can't get overly stuck with these things.
Well, in today's episode, it is an example, right? We talked about bonds.
Yeah.
Not a rabbit hole. We talked about mutual funds. Not a rabbit hole.
Yep.
Derivatives, you're going to get that, but if you tell me you missed your mark because of that, I'm gonna say I don't know. And then discount cash flow, I'm not going to believe you at all. I just finished a tutoring session, Brian, before we started our recording of this broadcast. It was so funny because I told her, listen, if you have a margin of safety, you can give yourself permission to guess B and assign it to the universe.
That's right.
And if you don't have that margin of safety, you can't. But if you have a margin of safety and you are one of these people who are worried about this quantitative stuff, just make sure you overlearn other areas where you then can say, you know what, B, I'll make it up elsewhere. Now, in that particular session, she did that, like, I'm not lying, 4 or 5 times, and it was all a B, and I had to spend the rest of the session, whoa. You need to learn the information. So, Brian, anything else we want to add before we give a little brief preview of episode 5 and just tell them what's coming for next week's episode?
Again, so a couple of things here.
Yep.
Again, we've said this over and over and over again. When you take your practice final and run the performance tracker, right, and they break it down into the 4 content areas, you can look at the investment vehicles and you can focus. Well, discounted cash flow, I only got 2 questions. I got 1 of them right. Cool. Moving on. Mutual funds. Oh, there were 6 of them on my practice final. I only got 3 of them right. Maybe I should spend there. So that's how it's going to help you determine where to spend your quality time. Right?
I would
you want
add
to
to that-
spend time on that other discounted cash flow question or the other 3 mutual fund questions.
Yeah, and Brian, the other thing I would recommend too, I always stress this, I don't receive any compensation from Test Geek Exam Prep LLC, but the PDFs, the practice finals alone are worth the entire course that Brian has, because that gives you that same confirmation of test issue or not. So when people now on the channel, Brian's been kind enough to let us have a video where you can hit pause, try and answer yourself, hit play, and then I will show up and tell you where you got it right or wrong. But that being said, Brian, sometimes people say, well, I just did the Test Geek practice exam. By the way, it's very strongly correlated. So I had a guy who 65 and he got 65 on the 65 Test Geek practice. I go, well, I got to tell you, my friend, had that been the real test, you would have missed the mark. Good news, it wasn't. You're testing Monday. If you don't get wobbly, you stay dedicated, disciplined, organized, you'll get it done. But a lot of times, Brian, they'll call and say, well, Brian doesn't have as many of these types of questions as my test prep vendor. I go, no surprise. That's the point, right? So Brian and I are not trying to sell you 1,000-page textbooks or turn you into a finance major. We simply want you to make your mark. That is our only agenda. Anything else, Brian, before I give them a preview for next week?
What's on the test, how it shows up on the test, and how you should answer it on the test. That's all.
That's it.
Thank you, Mark.
That's it. All right. So episode 5 next week will be on basic economics. We'll be talking about balance sheet basics. Oh, man, I'm so happy to tell you that the session will be led by Brian Lee himself, because we're also going to be talking about quantitative analysis.
Oh, boy.
Woo, alphas and betas. So should be another great episode. And we're doing a total of 6 in this sequence. In the 6th episode, we're going to do the last in the 65 podcast series, is going to be on recent changes made to the test specifications. Anything you want to say, Brian, before we check out
Now,
of this?
take effect June 12th,
June 12th. That's indeed right.
2023, I believe.
That's right.
When the test score comes down. Yay!
Woo-hoo!
And we've already mentioned how many rumors have already started to fly.
Oh, man, please. Same thing. If you have any urban myths you hear in the comments and the podcast, just put them there and we will set you straight, and maybe we can quash some of these rumors.
How can you be harder than the discounted cash flow for crying out loud, right?
There you go. Okay, well, as I always say, remember, inch by inch, your 65 is a cinch. And Brian, you say?
Stay with what you know. You take the test. Don't let the test take you.
See everybody next time, guys.
Take care,
and
everybody.
gals.
Goodbye.